Hello, my name is Revi Damayanti from Accounting Class 23A, with NPM 234120007. Here I will explain the material about common size analysis including the definition, function and benefits. Here is the material. The first is definition. Common size analysis is a financial analysis technique that converts each item in the financial statements into a percentage of the total relevant amount. In the income statement, each item is stated as a percentage of total sales, while in the balance sheet, each item is stated as a percentage of total assets or total liabilities. This method allows analysts and management to evaluate the company's financial performance in more depth and facilitates comparisons between companies in the same industry, regardless of differences in size or scale of operations. Next is common size analysis functions. Comparing companies to industry standards. Common size analysis allows companies to be compared to industry standards or key competitors. By converting financial statement items into percentages, management can understand the company's relative position in the market. For example, if a company's operating expenses are higher than the industry average, management can identify areas that require efficiency and cost reduction. This analysis also helps in measuring the company's performance objectively against its competitors. Identifying financial trends. Common size analysis techniques help in identifying trends occurring in the financial statements. By looking at changes in the proportion of costs or revenues over time, management can identify significant financial patterns and trends. For example, if operating expenses are consistently increasing as a percentage of sales, this may indicate an efficiency issue that needs to be addressed. This trend can also provide insight into how the company is responding to changing market conditions and business strategies. Evaluating company performance. Common size analysis makes it easier to evaluate a company's performance from one period to another. By observing the percentage changes in financial statement items, management can evaluate whether the company is moving in the right direction. For example, an increase in the net income percentage indicates an increase in profitability. Conversely, a decrease in the profit margin percentage may indicate a problem that needs to be addressed immediately. This performance evaluation is important for formulating effective and adaptive business strategies. Simplifying financial data. By converting financial statement data into percentages, common size analysis makes financial data easier to understand for those without a financial background. This makes it easier to communicate financial information to stakeholders such as investors, creditors, and management. For example, presenting marketing costs as a percentage of sales is easier to understand than absolute numbers. This simplification allows all parties involved to quickly understand and evaluate the company's financial performance. Next, benefits of common size analysis. Better decision-making. Common size analysis provides in-depth insight into a company's financial position, helping management make more informed strategic decisions. By understanding the proportion of each financial item in the context of total sales or assets, management can identify areas that need improvement or strengthening. For example, if operating expenses are too high compared to industry standards, cost-cutting measures can be taken to improve the company's efficiency and profitability. This information is crucial in formulating effective business strategies. Comparability across time and companies. Common size analysis allows easy comparison between companies of different sizes and helps in analyzing a company's performance over time. By converting financial statement items into percentages, management can evaluate whether there has been an improvement or decline in the company's financial performance. It also allows for comparison of a company's performance with key competitors or the industry average, allowing management to identify competitive advantages and areas that need improvement. Identification of financial problems. Common size analysis techniques help identify financial problems that may not be apparent in traditional financial statement analysis. For example, an increase in the proportion of operating expenses or a decline in profit margins may indicate efficiency problems that need to be addressed immediately. By understanding the percentage of each financial item, management can quickly identify anomalies or negative trends that require special attention. Identifying these issues allows management to take timely corrective actions before they escalate into bigger issues. Facilitates communication with stakeholders. Communicating financial information to stakeholders such as investors and creditors becomes easier with common size analysis. Data presented in percentage form is easier to understand, especially for those who do not have a financial background. For example, stating that marketing expenses are 10% of total sales provides a clearer picture than simply stating an absolute number. This simplicity helps in building trust and transparency between the company and its stakeholders, which in turn can support better decision-making by all parties involved. From the material, we can conclude that common size analysis is a very useful analysis technique for evaluating and comparing a company's financial statements. By changing the items in the financial statements into a percentage of the total relevant amount, this method facilitates the comparison of financial performance over time and between companies in the same industry. The main functions of common size analysis include comparing with industry standards, identifying financial trends, evaluating performance, and simplifying financial data. Its benefits include better decision-making, comparability across time and companies, identifying financial problems, and easier communication with stakeholders.